Okay, good morning, everyone. This begins day 2 of the Comprehensive Market Profile Seminar presentation in January 2011. Sorry about the power outage yesterday, but we recovered nicely from that. Fortunately, that didn't take as long as I had feared. I think there was an accident or something that took out a primary, I don't know what you call it, generator. There you go. Whatever it is, but they got it fixed relatively quickly. The good news was that it took out half of Savannah, so it wasn't like it could be ignored, and they got it up relatively quickly. Now, regarding the recording, as Harris said, there's 3 recordings because I stopped. When I left my office, my battery backup actually kept the computer up because the power came on relatively quickly, and the recording was going the whole time. So when you're listening to the recordings, when you hear me say, "Oh, the power's off," that recording, you can stop it. There's nothing else on there, and then go to the third recording that picks up in the presentation. So that will probably become self-evident if you're getting through it, but I thought I'd throw that out there. We'll use the same basic protocols today. I will present for about an hour. We'll take a short break. Everybody can sort of stretch their legs, get coffee, whatever, and then we'll continue. As yesterday, as I'm going along, type questions. I'll try and keep up with things. Your questions and your participation are important. Today, I will ask you to participate a lot. At one point, we're going to go through a case study. So before I begin, let me let me throw it out and see if if you have any questions, specific or general, regarding yesterday's material. Some of you guys have seen this many times. Some of you are watching it for the first time, so it's always interesting to get feedback. It's always a little bit different. You'll see that. And I'm sure those of you that are watching this for the third or fourth or fifth time know it was a little bit different yesterday than it has been. It's always a little bit different because of the participation. Let me sort of highlight and emphasize the gist of what we did yesterday. What yesterday was about. Yesterday was about establishing the foundation for the methodology that we teach. And I've used this analogy recently in these other little webinars that I've done about if you were building a house, you wouldn't start with a second floor window frame. You take a window frame, get a 2-story ladder, climb the ladder, and hang it out into the into thin air and drop it. That wouldn't work. But that's the approach, really, that most traders take. They never get a foundation, and they're always looking. They're looking for the finishing touch without having a basis for it. The finishing touch is the setup gimmick. And it is, and I know yesterday I said a lot of the same things over and over and over. And if you stay with us as clients for long, you'll hear those same things over and over and over again. We're very consistent, and we default back to these concepts. And the magic and the secret, really, of everything that we do is in this 2-day seminar, and in particular in the first part of it. Today we're going to get more into some of the more practical aspects of it, but everything that we do today defaults back to everything that was said yesterday. There is no example or case study or question that I'll ask today that could not be answered if you thoroughly understood the material from yesterday. So that material is important. I hope you'll go back and review it. It sets a foundation that will serve you extremely well regardless of the level of your trading. Gianpaolo, let's see. Gianpaolo, you keep asking the same questions over and over, and I'm not saying that's a bad thing, but the answers to your questions are you've had the answers to the questions. It's you need to go back and review the material from yesterday and study it, and the lights will come on. Just continue to work with this. This is the neat thing about this methodology is that if you really understand the details. Hold on a second. I just lost CQG or something. Hold on. If you really understand the details, once you understand them, it becomes extremely simple, and all the questions that you have when you're looking at a market are answered almost instantaneously. But it's like any other body of knowledge. We talked about this at the beginning yesterday. Trading is a profession. There are certain foundational principles that you have to understand. Raj is in here, and I know Raj is a physician, and Raj has had to take organic chemistry and anatomy and all these things. But when he is treating a patient, he's treating the patient. He's not thinking about the minutia of organic chemistry or anatomy. He's treating the patient. He's already immersed himself in those disciplines, and he has that information. He's just able to act on it. But the basis of his actions are founded in that valid information that he learned in medical school. Same thing for lawyers, engineers, etc. Well, it's the same thing with this. Learn the details and study it and think about them and ponder them. And then eventually, over time, you will see yourself looking at a market and just able to analyze it in seconds, as opposed to now, is that the high volume node that is trading up to, and is that an extreme? Do I take a responsive trade here? What time is it? Could this be an initial balance period trade? By the time you think about those things, and I could name a dozen others, a lot of times the opportunity is gone, or it's degraded. But it takes time to get to that point. I told you yesterday, I'm not expecting any of you to be able to come in Monday morning and perfectly apply all the concepts that we're teaching you in these 2 days. There's a ton of information in yesterday's material, and there's going to be a lot of information in today's material. But it is setting a foundation that if you really, really immerse yourself in this material and thoroughly understand it over time, it can dramatically change your trading. We have had many, many clients that have dramatically changed their trading from trading the material that you look at. What we do continues to evolve. We continue to try to add material and present material, but we are very consistent. You can ask clients that have been with us for years about the consistency of the approach that we take. We're not telling you one thing today and something else next week and something else the next month. And it's because of the methodology. The methodology itself is dynamic. I showed the example yesterday of how consistent the structure and the development of the market is, regardless of volatility. You can have volatility at historic lows, similar to what we saw in 2005, and then you can have volatility at historic highs, similar to what we saw in the fall of 2008. And you had the market, this auction process, still forming the same structures along the same lines, following the basic process, the three-step process that we talked about yesterday. And that enables you to make trade decisions based on the same type of information, the same objective, consistent information, regardless of market condition. The question regarding market condition is there enough range in this market for me to take good reward to risk trades? And the example of there not being enough range is, the market forms very pristine, perfect 1-minute auctions. Well, that's not really tradable. It's interesting, and you can certainly see the fractal nature of the auction process, but just the hard numbers, the math of the trade doesn't work. There's not a positive expectancy trading a 1-minute structure. So the issue becomes not so much specializing in a market, but there are markets at different times that offer different opportunities and have different ranges. And Harris may talk about that this afternoon when he talks. And it's another reason that we trade, and we encourage you guys to trade markets other than the stock indices. I'm using primarily stock index futures examples in this presentation. I could have used the yen, I could have used the euro, I could have used gold and silver. But most people come in expecting to see the S&P, so that's what we show. But it doesn't matter. This is a robust methodology, and it works. You could use it on Apple stock, IBM, Google, whatever. So, okay, we're going to talk about strategy. Now, this gets into more of a personal decision-making process. The methodology, I would hope, we all agree on almost 100%. You know, the basic foundational principles of auction market concepts we should all agree on. There should be very, very little deviation or question about those principles. Strategy begins to have more variance among traders as to how this can be applied. You know, strategies really are almost limited only by your level of experience and your goals and your account size, your risk tolerance, and things like that. There are a number of different strategies. I'm not going to pretend to give you all the strategies that I know of, and certainly there are a lot more strategies than I can think of. You know, some of you guys. Hold on. Some of you guys keep coming up with your own strategies that are just as good or better than ones I would have or Harris would have. I'm going to show you some basic strategies today that I do trade and that most of you trade and that are certainly tradable. Pretty simple things. You can get as complex applying these auction market principles, again, as your level of experience requires. You know, we're going to do an options, we're going to start an options program, as a matter of fact, but we're doing a webinar Tuesday and Wednesday on how to use options, how to combine options trading and auction market principles. And I've talked about that for years, how wonderfully this methodology lends itself to option trading. I just have never had the time to put it together myself, but now we have actually Alan Spohr. I think Alan's on a bike ride this morning. He was in the seminar yesterday. It's a very experienced option trader. He's putting that together for us. He's a client. So that's an example of how you can, something you're not going to see today that's a wonderful strategy. And there's strategies and tactics within options trading that lend themselves to that. All right, Harris, what do I need to change or send to? Are you talking?
No, I'm talking. That's for everybody. I want everybody to change their send to so that they send it to both you and me together, so that if I move the host around, everybody sees everything.
Okay.
Otherwise, it defaults to host only, and then if I take the host, you don't see their chats, and if you take the host, I don't see their chats.
Gotcha. Okay.
Does everybody understand what I'm talking about? Any questions?
Yeah, in the if you get ready to chat, there's a send to there. There's a drop-down box. That's what Harris is talking about. You want to send it to host and presenter. If you send it to host, I'm not going to see it because Harris is the host now. Did I make you the host, Harris? No.
You did, but I just gave it back to you.
Okay.
I'll
Okay.
take it back if I need it.
Okay, we're going to talk about strategy. Strategy is where the methodology does begin to take on personality, but it starts with, you know, let's get back to the basics. Everything defaults back to the concepts that we talked about in detail yesterday. The first thing you do in your strategy, everybody does this, everybody should do this, identify the present market condition. There are two market conditions. There's vertical development and there's horizontal development. Vertical development is imbalance. Horizontal development is balance. And then the second question you ask is, what stage is this? How mature might this be? And that's something that cannot be answered ever with certainty. That's something you get better at determining a mature balance area in a given time frame over time. But the concepts, you don't have to have the answer to that question to be able to trade with a positive expectancy. All you have to do is be able to identify that there is a balance area and have an awareness that eventually it will transition away from balance into balance. And if you follow the fundamentals, then you will be pleasantly surprised when vertical development occurs, even if you're terrible at guessing when it's going to occur. Because you basically, and we tell you in the report, so you don't have to guess. Harris will tell you in the live trade room, and certainly the advanced traders work groups are aware of this, that they are aware. You get a sense of when a balance is becoming mature, and then we will alert you. We will say, okay, now you need to begin to orient yourself to catching the initiative trade. In other words, be a little bit more patient with holding that responsive trade if it approaches the opposite extreme, because it's increasingly likely that your responsive trade that you entered at one extreme of the balance area could turn into an initiative trade at the and trade all the way through the other extreme. And if you don't understand what I just said, we're going to show you numerous examples of it today. And strategy also ultimately draws from the rich resource of our methodology, and it is a very broad, deep, rich resource. Now, most traders, let me talk about market condition a little bit. We say market condition. We don't say trend. The market is always in one phase or another, and that's a market condition. A trend is a phase of vertical development. And using these terms, I think, is helpful with getting you to change your perspective. You know, another theme we had yesterday, you have to change your perspective. Well, part of changing your perspective over time, you will tend to describe the market differently. And actually, you will describe the market more accurately. You know, you hear traders all the time complain, oh, the market's not doing anything. It's just chopping around in here. It's not doing anything. And what they're saying is, I don't have a clue what's going on in the market, and I can only make money if it does one thing. Well, the market is always doing something. And when most traders are whining and complaining about it not doing anything, actually you should get excited about it, because what that is, it's a balance area. And it's in a balance area where you get the most definitive objective information. You can very quickly make a logical, high probability assumption about the extremes of a range that is developing, and in other words, where value is and where value is not. And then when you've identified that particular market condition, that dictates the strategies that you use based on that condition. When that market breaks into, when it inevitably transitions into vertical development, you're going to use different strategies and different tactics. And that alone is going to differentiate your trading from 99% of all the traders out there. So, now, here are some facts that we talked about yesterday about helping to form trade strategy. Now, this is in your manual. You don't have to write this down. I really prefer, if you've got a question, maybe write it down, but I really prefer if you listen to me, watch the presentation, because A, you're going to get a recording, and B, you're going to get the manual. So pay attention. So here's some facts that you can use to begin to formulate trade strategy, and these are things we talked about yesterday. The two primary phases of market development, are balance and imbalance. Raphael, let me come back to that. Let me get through this and I'll answer that question. It's a good question. The two primary phases of market development are balance and imbalance. And when you're talking about, now the next two or three things apply solely to the stock index futures. The stock market forms a high or the high of the day, or the high or the low of the day in the first 30 minutes of trading about 40% of the time, in the first 60 minutes of trading about 65% of the time. And in the stock market, extension outside the initial balance period, in other words, the first range, the first hour of trading, is highly probable. There's like a 95% chance. Now, this applies to all markets in all time frames. Each day's high and or low very often forms near a market profile key reference area. You must always be aware of at least the next larger time frame than the time frame you're trading. What I mean by that is, if you are an intraday trader, if you day trade, what you have to do is be aware of what's going on the daily bar chart. The example that I use, this works better when I'm doing it live, but if you take your right hand and you hold up and you make a fist, and you hold up your index finger straight up in the air, that's excuse me, that's Monday, okay? Pardon me. That's Monday. So when I'm trading on Monday, if I'm day trading on Monday, what I'm really doing is I'm not trading that day, that finger. Now hold up your left hand and spread your fingers out. And you've got 5 fingers there. So this has already occurred, what's on my left hand. Now Monday is yet to occur. But when I'm trading intraday on Monday, what I'm trading is not that finger. What I'm trading is that left hand. I'm trading the development that has already occurred. The edge from Monday is the information from the previous 5 days, 6 days, 7 days, or longer. It's not about Monday. It's about putting the information as Monday begins to trade, as it trades, and where it trades, into the bigger context that's already occurred. Excuse me. Pardon me, guys. I'm going to sip of coffee here. Now, these are things that we talked about yesterday. Remember, this builds on itself. So everything that we talked about yesterday is still relevant today. We've got the 3 steps of market development. What are the 3 steps of market development? Guys, wake up out there. What are the 3 steps of market development? This is not hard. Alan Spohr yesterday, he got me 1, 2, and 3. What's Elena? Now you know this question. That's what are the pieces? What are the 3 steps of market development? Yes, thank you, Raphael. Vertical move in one direction, a stopping price, development around that stopping point. That's it. What are the key reference areas? What are the 3 primary key reference areas in a balance area? Yes. Yeah, exactly. You guys got it. Unfair highs and lows in the high volume node. Both extremes, high volume node. Value high, low. Exactly. Okay. What are the characteristics of balance? Now, Elena, no, that's not correct. Okay, you say price contained within a narrow range. It's price contained within a range. It might not be a narrow range. It can be a large range. And what does balance tell us? What is balance telling us? Value, exactly. Balance is when we can determine what value is, and as a corollary, what value is or where value is not. Now, what are the characteristics of imbalance or vertical development? Okay, Roberto, you say singles. Yeah, conviction. Singles are conviction. One-sided market. It's a market that's searching for value. Value's not known exactly. And it's only one party in the market that can create and sustain vertical development. And that party is big money. You know, back in the day, and this is part of the legacy of early market profile, there were all these categories of traders because it was a much more quaint world then where you could really put labels on funds, locals, public, etc. And the big money were primarily commercials and institutions. Well, that's not the case anymore because you can, and you know, they divided it up into the floor and then the quote unquote mysterious other time frame player. What was the other time frame player back in the day? That was the party that could come in and move a market directionally and sustain the market. Well, in this day and age, there's such an incredible amount of money being traded in all time frames that you can have an incredible amount of volume come in a short period of time, and then you can have that volume immediately overwhelmed and that entire move retraced by an even greater amount of volume, because you have hedge fund versus hedge fund and institution versus institution. Trading is computerized. It's a completely different world. So it's simpler. You've got big money and you've got us. I mean, that's the way it is. And we are not big enough to stand in front of big money. Actually, there's no big money that's big enough to stand in front of big money, if that makes sense. But it's also quite easy to identify when there is big money coming into the market. It moves it directionally. There's only one party in this day and age that can move a market directionally, and it's big money. And there's big money in all time frames. There's big money that just trades intraday. There's big money that just swing trades. And the big money, it's not always strictly directional in one market. Big money can come into the ES, and for all the world, it looks like the ES is going to zero, but in reality, they're selling the ES and they're buying the spiders, or they're selling the ES and they're buying the NASDAQ, or they're selling the ES and they're buying a basket of stocks. I mean, it's you know, you've got to understand the information that's in front of you and how to use it, and not make more of it than can be made. And it almost always comes down to an if-then approach. If I see a big move, a wide range move on a 30-minute bar chart, my assumption is that's big money moving the market. And then I have to wait and see how much of that is retraced, and then let the market retrace into it to give me an idea about what Tom Alexander can do in terms of taking advantage of it. So, you know, there is no magic to who's doing what, where, and when. You deal with the obvious that's in front of you. It will keep you out of trouble. Nobody knows. Nobody can know exactly who's doing what and how much. You have all the information you need right in front of you to make good, consistent, objective trade decisions. Stick with structure. Yes, Robin. Now, Raphael, I want to go back to, and this is important, and it does pertain to strategy. I want to go back to the question you have. Let me go back up here and find it. Okay, Raphael, this is key. All right, you say, where I struggle with this question is you can have a balanced market in one time frame and an imbalanced market on another time frame. Any suggestions? Yes. Well, let me do this. Hold on. Okay, this is a day time frame, right? I'm gonna see something here. I want to see the best way to make my point. All right, this is a weekly time frame. Now, from the March 2009 low into when was this? The April high last year. Do you understand that this is vertical development? Notwithstanding this, these declines, you're not, and actually from last summer, from the August to here, you've got vertical development, right? Is that clear? Raphael? Okay. Now this is weekly. You see up here? Now I'm going to make it daily. All right, this is daily. Now let's just take the vertical phase of development off of the August low. Now look at the pockets within this. I mean, you had a minor, oops, that's not what I wanted. You had a minor balance area that formed here, a minor balance area that formed here, minor balance area that formed here, minor balance area that formed here, 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 so on. I mean, it goes on and on and on and on and on. So you've got a larger degree phase of vertical development that's about as pronounced as you're going to get, but you've got pockets of horizontal development within the vertical development all over the place, even in one of the strongest bull trends ever. Now, if I were to take this period of time and break it down intraday, this is horizontal development, you would have vertical development intraday in here. Okay, I'll just do that. All right, this is January 3rd through January 11th. Okay, now this box is that vertical development that we looked at on the daily chart. Now look. All right, here we go. This is January 3rd. Okay, so this from January 3rd through the 11th is a phase of horizontal development, okay? But look, within this horizontal development, on the intraday time frame, you have vertical development, but you also have pockets of horizontal development. Okay? Now this is a very key concept, and it's very important, and I appreciate the fact that you shared that you didn't understand it. Do you understand it now? Because it's important. This is the key to being able to use this in a practical manner, this concept, the fractal nature of it. Okay? Giampolo, can I trade any horizontal development as long as I have an edge? Yes. We're going to go through some examples, Giampolo. As a matter of fact, Giampolo, that's exactly what I just did. I just took the S&P from weekly to daily to intraday. That's what you just asked me to do is what I just did. Okay. Now, a couple of things that are important to note to add to the information from yesterday about key reference areas and market tendencies. I read this excerpt yesterday out of Don Jones's book, where he describes that there is no statistical validation for the initial market profile concept that one day could predict the next day, and that even in a strong trend, there's only about a 50% chance that the next day will make, in the case of an uptrend, will make a higher high, or a downtrend a lower low. Markets are not serially correlated. That's what that speaks to. Now, what he doesn't say, and I've talked with him about this, and he doesn't say it explicitly, but he says it implicitly in his work, is that if you are in a phase of vertical development, you don't know if the next day, for instance, in the stock market, is going to make a higher high than today or not. But if it doesn't, as long as the trend is still in effect, each day that passes increases the probability that it will. Now that is tradable information, and it's important to know. And we're going to see some examples of that. So remember that. All right, Raphael, you say you need to take a closer look at steps 1, 2, 3. Well, let me go over here just real quick. I don't want to... You know, the 1, 2, 3 thing is happening in all degrees of trend all the time. And any vertical trend is a 1, and any balance area however minor it may be, is a 2 and a 3. It doesn't have to be a nice geometrically symmetrical 1, 2, 3 like a P or like a B. Like this, this is 1, this is 2, and then this is 3. And then this is a 1, this is a 2, and this is a 3, and it goes on and on and on. You can keep it simple by just focusing on when a balance area forms, and not get obsessed with 2, 1, 2, 3. It's the concept that's important. Don't try to constrain the market to time and specific geometric, perfectly symmetrical shapes. It's the auction concept that you're really focusing on. Okay. Now we're going to do a case study. So pay attention. I want everybody paying attention. This is important stuff, and this is going to address. It's going to require you to think about the material we've studied up to this point and to apply it. And I think that some of you guys that have questions about some of the questions you're answering will be answered by the time we get to the end of this. Now, here's the example we're going to use. If you look over here, this is October, let's see, when was it? All right, this was in 2005. So this was October 2005. Most of October 2005 formed a balance area. Now, Elena, look, this is a pretty wide range balance area. It's not that narrow. That's why I said no when what you posted. It's important to know that balance areas can be relatively narrow like this one is, or they can be relatively wide like this one is. Okay? Now look what happens. A balance area forms, and what do we expect? What do we know follows a balance area? Vertical development. Now, this is 11.2 on the bar chart. This is 11.2 on a profile chart. Now, on 11.2, what may have happened here? Is there anything particularly telling about 11.2? Well, it appears to be, yes, Raphael, you say breakout single print. It appears to be confirming the breakout of balance. The breakout here looks like it really began back on this day. I'm not sure what day this was. This was probably October 28th. But you have a lot of conviction in this, don't you? You have a lot of conviction after testing the breakout point. You've got a buying tail. You have, the magical single prints here. All of the development in the market occurred in the upper 25% of its range, and the market closed on its high. So all of this day, this individual day. Now, we say that days are not predictive. They're not predictive, but there are certain days. Transition days, for instance, give powerful if-then key reference areas. So if I'm trading the S&P on this day and I see this occur following, confirming the breakout of this, then I am biasing my trading to long trades as long as the key reference areas formed here are not taken out. And that that is as objective as you can get, and it's incredibly confidence building. You know, one of the things that I heard Stettlemyre say one time in a lecture that I thought was very, very interesting and useful is that if you know, proper use of these concepts can at times help you eliminate one side of the market. So in other words, when I see 11.2, I know that the path of least resistance in the S&P should be up. It should be up unless that high volume node at 11.2 is taken out. And as long as that high volume node holds, I have reason to be aggressive looking for long trades, and I can, for a while, unless I have really good reason, I can eliminate the short side of the market. Because if I'm right, if the message from 11.2 is accurate, the path of least resistance is up, and the surprises should be to the upside. Right? Now, if the market is transitioning to the upside, it doesn't mean that 11.3, 11.4, 11.5, 11.6, 11.7, 11.8, so on through the month of November is going to be up every single day. That's not what it means. But it does give me a reason, it gives me an objective marker, both in terms of condition as well as practical lean in terms of, all right, my assumption is the market is going higher unless at this point, based on the information I have, 11.2 is taken out. So this is a much higher level way of analyzing the market, which leads to more effective trading. You're beginning to think about market development and market structure. Now notice I'm not wondering if the Fed's going to tighten rates, loosen rates, if the Bank of Japan is going to do something, Trudichet is going to say something. All of that gets factored in. If any of that is relevant, the high volume node on 11.2 is going to get taken out. And until it does, that's the objective information I have. The information that I'm basing my trading on is a view of value, and that value is determined by insiders, the two most important insiders in the world. That's the buyer and the seller, and not about what somebody somewhere is saying about something, an opinion. It's based on the actions of the buyer and the seller that are engaged in the auction market. Yeah, Robin, it is. I mean, this basically is a buy signal, to put it simply. Okay. All right, this is 11.2, and now the market begins trading on 11.3. All right, this was the close on 11.2. Now, remember this. This is that high volume node on 11.2. Okay, this is the high volume node on 11.2. This is the structure from where 11.2 is breaking out, and then the trading begins on the next day, and the first rotation is complete. Now, what do you do? Who's going to do you want to short this? Do you want to buy this? You're trading. You're going to make a trade decision. What do you do here? Trevor, just use the information here. Forget that for now, okay? Okay. Is there a good trade decision to be made based on this information? No, there's not. Okay. Now, the second rotation is complete. And let's say it's 10:30. The clock just hit 10:30. We're just about to begin the third rotation, and the market's trading right here. Is there a trade? Why is it a good place to buy? Why would you buy it here? Okay, Roberto, yeah, the high volume node is down here. Now, if you go long here, are you saying your stop's going to be down here? Yeah, it's too far. If you're putting your stop, if you're basing a long here on a stop here, you don't take the trade. But if you're basing your long here on the fact that this could be the low of the day, and you're going to only let it go 2 or 3 ticks below this level and stop yourself out, I consider that an aggressive trade because of this gap. But that's a great trade because you could be catching the low of the day. Robin, you got it right. But Roberto, you don't take a long here and under an assumption you're going to let it go all the way to here. There's no reward to risk there. But if your assumption is, okay, it's 10:30, the low of the day could be in place. I think, that we're going to rotate higher. I'm going to take a long here, and I'm going to risk, 4 ticks below the low. Now, understand, and this is important. Don't turn this stuff into magic. In other words, don't put a low, don't go long here at 10:30 and put a stop 2 ticks below this. You're going to get stopped out more times than not. You want to put stops. You want to trade market condition. You don't want to trade price. And this is an example of using a stop based on a market condition and not price. So if I'm wrong, if I go long here, I want to be long unless I'm wrong. And it has nothing to do with a tick or 2 below the low. That's an artificial constraint on the process. Remember, we're trading market condition in a process. Graphs, bar charts, and market profile, any type of chart has limitations. You're not trading the chart. You're trading the market. This is just a visual aid. Now, using our statistics, the trade is not invalidated if it trades a few ticks below this level. But that's what I have to do. If let's say I buy this market a handle up, so 4 ticks off the low. Well, I've probably got to put a stop 4 ticks below the low, so I'm risking 2 points. I have to be willing to risk about 2 points, 2 handles. Is that too much? Is that too much risk? Okay, you say no, Roberto. How do you know it's not? Why is it not? All right, let me ask this. What do I use to determine how much risk is too much or not? Okay, thank you, Trevor. Potential reward. If I'm risking 2 points to make 10, that's a 5-to-1 trade. If I'm risking 2 points to make 8, that's a 4-to-1 trade. If I'm risking 2 points to make 2 ticks, like a lot of these guys do, that's ridiculous. If I'm risking 2 points to make 2 points, that's a bad trade. Now, that said, and some of you guys have correctly identified this, it's not. There are 2 questions that each individual has to answer. Everybody has to answer this question: is there enough reward in the trade to justify the risk that I have to take to get the potential reward? And my general guideline is, you guys don't want to be trading for less than 3 to 1, 3, 4 to 1. And that's realistic. Now, the second question is, okay, what is the 1? Can I afford the magnitude of the 1? And if you can't afford the magnitude of the 1, you don't take the trade. And what happens with traders is they see the potential reward of the trade. A lot of traders, especially undercapitalized traders, they'll be able to effectively recognize the potential for the trade, and then they'll see the amount of risk that they want that they have to take, and say, well, I can't afford that, so I'm not going to use that tight a stop. Well, they've just dramatically decreased the edge in the trade. They've changed the equation. They're probably going to get stopped out. The market doesn't care if you can't afford the amount of risk that is required to accept the trade idea. So you have got to allow your stop to be at a point that it invalidates the idea. And if you can't afford that, don't take the trade regardless of the reward of the trade. Because what you're doing is you're changing the parameters of the trade. You're changing the numbers. You're creating randomness. It's very important. Well, Daniel, you say, I assume you're going to address where to place stops and also when the trade has become invalidated. Yes. And in this particular instance, if I'm taking an initial balance period trade, should not trade outside the second rotation by much or for long. Now, that's somewhat nebulous, but, if you trade 2 or 3 ticks lower in the next rotation, it doesn't invalidate the trade. And, Daniel, here's something else. In our methodology, the tighter the stop, the worse off you're going to be. And this systems traders will tell you this. Stops degrade systems. Now, you have to have a stop, but what we use as a stop, and it's not the same. Sometimes we might risk 2 handles. Sometimes we might risk 5 handles on a trade. I will risk 5 points in the Russell on a day trade sometimes. That's $500 a contract. But that's in certain trades, that's what it takes if you're trading the Russell. Yes, Robin, I know you do this. You've got to trade market condition. Okay, this is ultimately what happened on this particular day. If you had taken the initial balance period trade, you would have had, you wouldn't have lost money, let's put it that way. And you would have had the opportunity to catch a substantial portion of the day's range. And that's what you're trying to do as an intraday trader. Remember, the best trades occur at the extremes. And one of the extremes, time can be an extreme. And if you're around that 10:30 time period and you're in the second, third rotation and it's near what is at that point in time the higher the low of the day to that point, I think you could almost rote trade it with a 6-tick stop at in this period of time and have a positive expectancy. Now let me go back, okay? Because time matters. So if the second rotation is completing right here and I go long, that's a good trade. Let's take a hypothetical. Let's say, all right, so it's 10:30 here. Let's say 10:30 is here and the second rotation is completing. What do you do here? Skip, you say you short it? Anybody else? Trevor, you wouldn't do anything? Robin, you... Okay. Trevor, why would you do nothing? Elena would short it with a 6-tick stop. Trevor, you're still long. That's cheating. You can't do that. But you know what? That's the right answer. I like it. I like the thought process. All right, now this is sort of a trick question, and there's really not a wrong answer. An aggressive trade would be to short it because you've got such a defined risk. You know, if you're 1030 here, you can short this here with a stop, 4 ticks above the high, and you've got a positive expectancy. But if you're thinking about, okay, what did we just come out of? What do we say about the condition of the market? The path of least resistance is up. And if I could choose, it's acceptable to do it, don't have to do it, but I could choose to eliminate one side of the market or the other. And obviously, if I've eliminated one side of the market, I've eliminated the sell side. So this is a more ambiguous situation up here than down here. And there's not one right answer. So do you understand the distinction between going long here and going short here, and why? Okay, Daniel and Skip, you say no. Okay. All right. Let's get back to this. All right. What has this told us? No, this entire day. It's confirming a breakout of balance, right? It's conviction. So our assumption is that we're probably entering a phase of vertical development up, right? So the path of least resistance is up. That's what this is telling us, and that's my takeaway coming into the third. So if that's the case, now we do have this big gap here. I don't want to see the market take this out. That's gross information. That's macro information, and I might want to be biased to the long side. And the surprises should occur to the upside. So if I'm here, and it's 1030 and I take a long, I can take a long against a few ticks below here, and I've got all this information, all my working assumptions on my side. If I take a short trade here, what I have working for me is the potential for the high of the day to be in place, and then what I'm looking for that trade is a rotation lower that holds no worse than somewhere in here. So this wouldn't be a bad trade, but this would be, to me, a more aggressive trade than this. This trade has my bigger set of assumptions on my side. This trade is going counter to my bigger trade assumptions. It's not wrong. Just be aware of it. Okay, it's 10:05. We're a little past an hour. Let's take about a 5-minute break here, guys. All right, now this day is complete. Now we're doing our homework. So what do we know? What are we thinking about coming in? What piece of information has this provided us that could give us an edge the next trading day? All right, Daniel, you say it filled the gap. What's the significance of that? All right, this is your last statement. You say it retraced at the top of the high volume node. Yeah, the significant thing, there are two things. There are a couple of other takeaways here. What this has done now, the market continued to trade higher. It probably got extended in the very short term, because remember, this day, this 11/2, was an extremely wide range day. So this market gapped up, and then it became rotational. It traded down right to the day session high of the previous day. It didn't get into this area here. Now, if I'm coming into, what am I thinking about? Where are my best trades coming into 11/4? Yeah, Robin brings out. Let me digress for just a minute. You know, we talked. Daniel, you threw out the gap thing. Robin says gaps can get filled in Globex, et cetera, et cetera. You know, gaps are part of the magic du jour these days. I mean, there are services that just trade gaps. Well, there's really no such thing as a gap anymore. The market trades 23 3/4 hours. There's no gap. That's, you know, what a gap used to represent was imbalance overnight, because the markets didn't trade 24 hours. So if there was some sort of exogenous event that occurred overnight, it would create an imbalance in immediate supply and demand, and you'd have the market gap up to absorb the supply or down for the demand. But in these days, you can't rote trade gaps. There's no edge to that. What you're seeing here will give you a much greater edge. Now, this is a case study that does not use Globex data. We actually do use Globex data in the live room, and there are important parameters that you can derive from Globex data. However, that doesn't change or invalidate anything you're learning today, okay? But Robin, you bring up a good point. That's probably something that should be addressed. Okay, so what I want you to tell me now is what is additional information now. If I'm dreaming at night of my ideal trade the next day or two, what would it be? What are the areas on this chart that I'm most interested in coming into the next day in a vacuum based on the information I have, where I have the best opportunity? Well, right, Roberto, first of all, you're right. The vertical up, my idea that the path of least resistance is up, is still intact. Okay, Robin, that's right. The low of the day is important. This low is important. What about the high? Is this high important? Yes. Yes. All right. To me, the three areas that are most important right now, based on the information we have and our macro assumptions, the high of the day, the low of the day, in this area of the high volume node in here. So this is a key reference area, this is a key reference area, and this is a key reference area. Those are the three areas that I would focus on. Okay, now I've collapsed the third. The fourth has begun trading. And let's say it closed right here. The first rotation, it's now 10 o'clock, about to begin the second rotation. And the market's trading here. What do I do? Skip, why are you going to wait? Well, the reason you're going to wait is because there's no edge. That's why you're going to wait. And you answered it. You're going to wait until it gets to an area with an edge. The only reason to trade is because you have an edge. So if you're not trading, it's because you don't have an edge. It pretty much comes down to that question. Okay, now, all right, now it's 10:30. The market's trading here. What do I do? Skip, you short it? Why? High area developing? Why is that a high area developing? Maybe not. Well, Skip, I appreciate you. You know, you're sticking your chin out there and throwing it out. Okay. Well, let me explain why. Now, the reason to take a trade here, the rote reason, would be because the initial balance. It could be an initial balance period short. I don't like that trade, and I think initial balance period trades are over traded. That's a statistical factoid that is most of the time just that, a statistical factoid with no real edge. Now, if B had come up to here and then C is testing it and it coincided with the previous day's high, that would be a more interesting situation. Now, I do realize it's at the high volume node of the previous day, but that's not enough for me. I want it to be at a real extreme. So if the market's trading here at 10:30, I'm probably not going to fade that. Now let me ask you this. It's 10:30 and the market's trading here. Do you go long? Or do you go short? Would you go short? All right, you go long, Skip. Why would you go long? And why would you go long here? Where's your stop? If you go long here, where's your stop? Bottom of yesterday. So you're going to go long here and you're going to stop it out here. Is that right? Okay. All right. I'll say this. If you go long here, that's probably the most valid stop. It wouldn't be a couple of ticks down here. But if you go long here and that's your stop, what's your expectation for the trade? What's your potential reward? Let's just guess here. I'm sort of eyeballing this. But if you go long here at 12, let's just round it off and say 12.21, and you stop it out here at 12.18. That's three handle risk. The high here, all right, 12.21 up to 12. What's your target? Let me ask you this. If you go long here, what's your expectation? The high of the day? Well, if it's the high of the day, then you're going long at 12.21, and your target is, let's call it 12.26. So your potential is 5 handles, and you're risking 3 handles. That's not a great reward to risk. If I go long here, I'm looking for this high to be tested at a minimum. I'm not going to get, if it goes to here, I'm not getting out of the trade. Remember, you're trading you're trading development. Don't get hung up on the single day, just trading the day. You're trading the bigger picture of development, what you think is going to happen. I like the idea that you said, all right, I'm going to go long here, and I ask you where you put your stop. Most people have said 2 ticks below this low. You did say below the low of the previous day. That's good. I mean, that's where your stop would have to be if you were to go long here, to really invalidate a long idea. But your idea about your target being the high of the day to that point is not so hot, because your reward to risk isn't even 2 to 1. Okay, Daniel, you bring up a good point. I'm going to read this. I still don't understand the concept of rotation in terms of time. I mean, I understand time frames in fractal, but why make decisions that are based on a random time slot, such as every half hour on the hour? I just don't see why the market would make notice of the time rotations versus price rotations, which seem more valuable to me at this stage, blah, blah, blah. Excellent points. And the only reason that this applies just in the stock index futures, and it's based on statistical analysis. And I keep up with it. And as I said yesterday, at some point, I'm not going to be surprised if this no longer provides an edge. But at this point in time, it does. And I'll show you at the end of this case study that it does, using the present contract. But in terms of using time as a parameter, in this particular instance, we're using time based on previous statistical analysis, and that has provided an edge. But again, I'm not using it in a rote way, which is why I wouldn't, if I just used it in a rote way, I would go short here. I said I don't like that trade. It has to line up with other things, other key reference areas, my macro assumptions about the market, etc. Otherwise, it's useless, even though it does have statistical validity behind it. To apply it, it has to be put in context. But you raise a very good point. So do you understand my explanation? Okay. Skip, you got stopped out, bud. All right, now it's 11 o'clock, and we're about to begin the fourth rotation. We've traded into the high volume node. Do we go short here? All right, let me ask you this. Is there what do you do? The market's trading right here. What do you do here? Is anybody going to go long here? Roberto, you say this is a point of ambiguity. This is about as definitive as it gets, frankly. I would go long here. I would be jumping all over this based on the information we have. Because if my macro assumptions are in place, the market has now traded to an extreme, both in terms of time and structure. What did we say yesterday about the best trades? Where do the best trades occur? The best trades occur at extremes, right? Well, this is an extreme in terms of development, the bigger phase of development. It's an extreme in terms of structure, and it's an extreme in terms of time. So I'll buy this and use a 2.5, 3 handle stop and have a great reward to risk trade. My potential for this trade is to test this high. It's at a minimum, it's to take this high out. That's a reasonable expectation. So I'm going to jump on this trade all day long. And Skip, I'll tell you, your idea about going long here was not that bad of an idea. But if you got stopped out, instead of sitting there feeling sorry for yourself, you had to go back in and take the trade again. Yeah, Robin points out, because this is such an extreme trade location, this has the potential to be a swing trade. Daniel, you say, is this what is called a virgin naked POC, not as a magical concept, but the idea of an area? No, it has nothing whatsoever to do with that. Giampolo, what do you mean if you're stopped out again? I mean, you've never had a day where you're stopped out twice in a row? You're good. I mean, you keep taking the trade as long as it's not invalidated. And this is actually not the same trade. This is two different trades. Taking along here with a stop here, that trade didn't work. It was invalidated. But then the fact that the market came down here, and let's make an assumption that it paused in here, and you can go to a 5-minute chart and find a minor balance area, etc. Going long here is a different trade. So it's really a different trade than the long taken here. It's not the same trade. Now, I'm not, I don't, the big mistake most traders make, Skip and Daniel, is that they trade too much. I'm not suggesting that you need to try all day long to discern the next 7 or 8 handle move in the market. Sometimes you're just not going to get it. But when the opportunity, when there is an edge there and these things line up, you got to take them. They're probably, in hindsight, if you go back each day, there might be, on average, maybe 3 or 4 good opportunities a day in hindsight. So, you're an outstanding trader if you can recognize 2 of them consistently. Per product, Daniel. Intraday, say, in the S&P Mini. Okay. Here's the answer. This is what happened. So if I had gone long down here, I didn't get the result that I wanted. But I should have made some money. Now, something else I want to point out. If I go long down here and the market begins to rotate and trade higher, my trade is not invalidated unless it trades below here by, I'd probably give it 2 or 3 ticks, right? 99.9% of all traders, if they go long here and they see the market trade up into this area and then it starts to retrace, what do? They raise their stop to break even, or they take a 3-tick profit. They either take a 3-tick profit and get stopped out. And then the market begins to trade higher, and they say, oh, crap, I missed something. They buy it. And then it rotates down, they get stopped out again. So what happens is they get caught up in the noise. And this gets back to the time component. Giampaolo, you asked about it yesterday, and Daniel, you asked about it a minute ago. This is where an understanding of time and development comes into play. When you think you may have caught the low extreme of the day, you may have to sit there for the rest of the day to get the reward. But the trade, natural rotation, this is a normal function of a market. This is a market that is facilitating trade. You're seldom going to get in here and have this market go straight up and satisfy your potential. It is much more likely to do something like this. And if you get itchy and twitchy because you have a 3-tick profit and you lower your stop or for no reason to break even or to take a partial profit, you're going to miss the potential there is in the trade. And that's how most intraday traders trade. Once you entered this trade, once you had identified the trade location and you had properly assessed the entry based on both the macro picture as well as the immediate structure of the market, then your job was done. You've entered the trade, you put your stop in, and then unless something that you can't see on this chart invalidates it, the only thing that would invalidate it would be if the market traded below the low of the day at the point of the time you entered the trade. And so you would sit through this and not get twitchy and itchy and raise your stop and re-enter and get stopped out and get chopped, into a fine, pureed mess. Well, Giampaolo, you asked the question, why was the stop not below the 11.2 HVN? Well, it would be acceptable to put it down there. But once the market begins trading, it's at this point, with as much momentum as you had in this period, I don't want to see much momentum below this or dramatically increases that's going to be taken out. So once the market holds and it begins to form this, then it sort of cements this level because it's into the high volume node. So, I'm not going to put a stop down here at 12.14. I'm more likely to put the stop at 12.15.5, somewhere in here. 2 or 3 ticks below this low, but not necessarily 2 handles below this low. Yeah, Daniel, I did. There's not an exact entry here. When I see the market trading down here, I'm saying to myself, okay, this is make or break for my entire macro assumption. And you know what? It does 2 or 3 ticks where I enter doesn't matter. I want to enter in as close to where my macro idea is invalidated as possible. And it doesn't matter if it's here, 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 here. That's something else about this methodology. We're not price-based traders. We're trading market condition. It's a much more forgiving way to trade. You don't have to get an exact price to have an edge. Okay, you asked the question, at the point of entry, do you look at other things like crossover moving averages or stochastics? No. Now, we don't look at moving averages. We don't look at stocks. We do look at breadth, and we look at volume and market internals, but we're not looking at stochastics. Actually, if I were going to use any sort of oscillator, I would use moving averages. But no, we don't typically use moving averages. What are the moving averages going to be if this thing is trading down? You're going to be entering counter to the position of the moving averages. I don't care what the moving average is. One thing about moving averages, it's a visual crutch. I can tell you, you never want to be on the wrong side of moving averages for long. But I don't need the moving averages to tell me that. I can actually show you a way to use moving averages, but it confuses a lot of people, and you're not going to see them in here. And we really don't teach using any indicator other than the market itself. But just in the interest of intellectual full disclosure, I can see a use for moving averages. And I have taught how to use moving averages. But stochastics, RSI, MACD, CCI, that's worse than not helpful. That stuff is actually harmful. That's part of the predicting mindset. If you're using stochastic or RSI, what you are implicitly saying is, I need to know something more about the market than price alone can tell me, which is true. But what we're showing you is that information. We're giving you information about how the market develops by using information derived from the market itself, not a derivative of information from price. We don't trade price either. We're actually trading market development and market structure. Yeah, Roberto, most of what happens every day is noise. Look at the previous day. This day collapsed. When I have the rotations collapsed, you see how rotational it was? This day's rotational. That's why it's important to trade at the extremes. When you're trading at the extremes, you're doing the highest probability thing that you can do to remove yourself from the noise. Actually, Daniel, it won't be painful. It will be less painful. Well, Roberto, recognizing is the first step. You can't change something unless you recognize what it is. Is this a 12-step program? I don't know. Maybe more steps than that. Okay, next day. Now, what do we know? Actually, this day, let's go back. Now that this day is complete, what is the information that's been provided from this day? Has it further defined anything for us? Okay, Roberto, it may be building balance, right? Yeah, John, the macro assumptions are still in place, and in a smaller time frame, we could be building a balance area, right? If we're building a balance area, what does that tell us? Okay, Elena, we might have a low in place. Thank you. And that low, the low on the 4th, is a very important low, isn't it? Because it's very close to the point that would bring into serious question our macro assumptions about the larger phase of development. Our macro assumption about the larger phase of development is still in effect. We think it's vertical up. And remember, we said prior to the 3rd that the first thing that would bring that assumption into question is if the market subsequently takes out this high volume node. Well, now we've had a day that has come down and tested it. So this begins to find this low area here as a very important area. This is an inflection point. This is a key reference area. And what do we know? This is an extreme. All of those things are what? What do those things add up to? Well, exactly, John. It adds up to an edge, but it adds up to trade location. And trade location is not trade location unless there is an edge. Opportunity, an edge, exactly. You don't have edge without good trade location. And you don't have good trade location unless it provides an edge. They go hand in hand. So that, John, that's a good answer. Okay. All right. So on the 7th, this is where the first rotation completes. It's 10 o'clock. Is there a trade here? Guys? Not for you? Not Elena, not really? No, I don't see a trade here. And why? Why is there not a trade here? At this point, where are the trades? Just on the information you have here, where are the best trades going to be based on what you see here? Well, that's sort of a trick question, but the obvious answer, there are two obvious places. It's near this high and it's near this low. Now, between those two areas, and Robin, you've identified this high volume node. Under certain conditions. Now, Skip and Daniel, I want you to notice, we're not taking this day as a discrete event or this day as a discrete event. We're taking it as a form of development. Now, our macro assumption comes from what happened over here. Our macro assumption is that this day confirmed the breakout of a rather large and rather time-consuming balance area. So the transition to vertical development has potential. We know what invalidates that assumption. And then we have this day trade and we have this day trade. Now we have sort of a subset assumption that we could be forming a balance area. And if we're forming a balance area, what is important are the extremes of that potential balance area that are forming. So it's the high of the third and the low of the fourth. So now you've got assumption, a macro assumption. You also have an assumption, and now we're trading today. Remember when I did the finger thing? Are you starting to see why when I'm trading in this day, I'm trading this, and my assumptions about this are based on an assumption about this. So it's a much higher level of decision making than anybody else out there trades. Daniel, you ask a great question. If we took the trade on the 14th, are we still in that trade? Well, if you remember, Robin pointed out this could be a swing trade. Yes, it would be acceptable to still be in that trade. Absolutely. Trevor's still in the trade from the second. Trevor bought the low of the second, and he's still in the trade. Okay? All right. Okay. It's 10:30. Robin's going long here, right, Robin? You wanted the high volume node, you got it. Daniel, you say you don't understand what our targets are supposed to be. The targets are always key reference areas. And key reference areas are extremes. And what your target is depends on what your entry is. And I'm just going to go a hypothetical. If I were to go short here, my target would be at a minimum the high volume node, but more likely this low. If I were to go long here, my target would be above this high. And there's always a default. You can always default back to these key reference areas. Your leans, your stops are some key reference area that would invalidate the idea. And your targets are always some key reference area that is a logical extension of what you think the market is doing from a development perspective. Daniel, you're going to have to listen to the recordings of this a couple times. Everybody does. I mean, there's a lot of stuff here, but you'll go back and you'll listen to it over and over and over, and you will the lights will continue to come on. Okay, Robin, so are you long here? Did you buy this down here now? You're sort of like Doug. You're a pretty aggressive trader. You don't hesitate to pull the trigger. Now let me ask you this. If Robin goes long here, where does he put his stop? And I'm asking Robin, and I'm asking the rest of you. We're trading Robin's money here so we can be aggressive. Roberto, you go long here with a 3-point stop. Why do you use a 3-point stop? Well, so if you use a 3-point stop, a 3-point stop doesn't mean anything. Let me ask you this. From a structural perspective, Roberto, where do you put your stop? Below the previous day low. Okay. So you're going to go long here, and your stop is down here. Is that right? Okay. Well, there are two places to put your stop based on the information and the question I ask. If this is 1030, based on an initial balance period trade, you could put your stop here, but you'd have to be willing to re-enter if the market traded lower. What would really invalidate the long, however, is a stop down here. So personally, I'm not going to go long here. You could go long. This is a more aggressive long, and this is an initial balance period time period. But I'm not going to go long here. Now, if C were down here, I'd jump all over it. I would load it up because I've got better parameters. But going long here, from my perspective, is the same thing as going short here. It's not against a primary key reference area, so I'm not going to do it. Now, it is into the high volume node. I get that. So if you go long here, that's why I say this would be an aggressive trade. It's not one I would take, personally. Where would my stop be, Raphael? If C was at the prior day's low, it would be probably 2 handles below here. 2 points. So I might be risking 3 points. Because at this point, I'd want to be wrong before I got stopped out. I wouldn't want to be, nicked out of the trade, because the potential for this trade is enormous. If I had the opportunity to enter this trade down here, the potential is enormous. So I'm willing to use a 3-point stop. What's my potential if I enter a trade down here? Actually, what's my potential if it's the same as I enter a trade here? If I'm going long anywhere in this area, what's my potential? The sky's the limit. Giampolo, absolutely right. The sky is the limit. I'm looking for a continuation of vertical development sooner or later, right? And Raphael, your answer is also correct. My minimum target is the high of the day. That's my minimum target. Daniel, you say you do not consider the point of control a key area to trade from. In this particular instance, it's a minor key reference area because of the bigger picture of what's going on. You have to put the structure. This is a piece of structure, and within the single day structure, it has structure. This is a high volume node. It is of importance, but of bigger importance is that we could be developing a balance area here, and this is the upper extreme of that balance area, and so far this is the lower extreme of this balance area. I also know that this lower extreme, because of where it occurred, is really important. This is ideal trade location. This is somewhat less than ideal. This, to me, a long here would be an aggressive trade. I'm not saying it's wrong. I'm just saying it's aggressive. It's not as defined. A trade here is make or break. This market stops within a handle or two here, or it invalidates two significant larger degree assumptions outside the day time frame. However, if it's right, it validates two larger degree assumptions, and my reward is, even if I'm risking 3 points, my reward could be 10 times that over the next few days. Yeah, and that's something else, Robin. If the market trades down here, you're going to know real quickly if you're wrong or not. It's not going to be a slow death. Yeah, Robin, I prefer the quick death over the slow grinding death any day. In other words, entering along up here and have it dribble down to here and get to make or break and then go swoosh through. All right, Daniel, so if you traded on the 14th, would you still be in the trade as it retraced all the way back to where it is now? You could be. It would be acceptable to be. It would be based on your trade plan, the time frame you're trading. And that's something else. You can trade, and most of the advanced traders that I know, and I do this, I trade different time frames. I might have a long-term, an intermediate-term position on that I'm not going to touch unless it invalidates the trade. But intraday, I'm either day trading with the direction of the trend, or I'm trying to add to the position. Okay? All right. Now, this is interesting, okay? This gives us more information. What do we know? What do we know now? The third rotation is just completed. Forget where it stopped. We'll get to that in a minute. But just based on this information, what do you know? Roberto, you say the low of the day might be in. Yes, the low of the day might be in. Elena, you say randomness. Yeah, it's pretty random so far. But what else? There's some other stuff. Roberto, you say the low of the day might be in. What else could be in? Yeah, the high of the day could be in too. So what has, we've completed 90 minutes of trading, and what has not happened? Expansion. Yes, Giampolo. That's the answer. We haven't taken out the high or the low of the day. 95% of the time, you'll take out the high or the low of the day that's formed in the first 60 minutes of trading. So that can enter into our trade decisions going forward. Now, if the market closes here as it completes its third rotation, Robin, at this point, I'm more likely to try long than at the completion of this period here. Now I might try long and use, a 3-tick stop. This gives me more confidence and gives me additional probabilities that this is going to hold than just the fact that this traded into this high volume node and stopped at 10:30. So if this is 11 o'clock Eastern time and it trades to here and I can get a long on, I would be more inclined to take a long in this period under these circumstances than I would have before. Roberto, what you say? Are you saying it is safer to take a long here? It is safer. Well, you're taking a long in the same position at the exact same price level. It's just that you have additional information. And the fact that this is held now for another rotation increases the probability that you're not going to trade below this low and that this could indeed be the low of the day. So as opposed to the more aggressive entry that would have occurred at, let's say, at 10:30 when it was trading down into this area against the high volume, but that's probably not a trade I would take. I probably would take a trade in this area at the completion of the third period if I could get a trade on somewhere in here. But I would not put a stop all the way down here. I would put a stop 3 ticks or so below this low. And then if I had to re-enter if it came down here, I would do that. But you're talking about, at this point, in my mind, 2 different trades. Now, Roberto, do you understand why I wanted you to see this? Are the lights coming on a little bit now? I told you. All right. Now we've got another rotation. Okay. Now, what do we know now? It's still rotational. Now, this is sort of a nuanced point. This is an advanced concept. But it is a direct extrapolation out of the information that you've heard up to this point. If I'm sitting here and I see a market that is relatively narrow range, is not traded outside the initial balance period, I know that there's a 95% chance at some point during this day, the lower the high is going to be taken out. Now, at this point, if I don't have a trade on, the only places for me to consider putting on a trade are very close to the extremes of the day to that point in time. But as the day wears on in times, I am decreasingly likely to want to fade the extreme, whether it's the low or the high. Why? Because remember, there's a 95% chance the higher the low is going to be taken out. So if this completes a few more rotations and we trade down here, you could say, yeah, well, that's an incredible reward to risk trade. but the probabilities are increasing rather dramatically. That it's a low risk long, it's a great reward to risk long, but the probability of it working in terms of being a responsive trade are less and less. So what happens is that your strategy begins to change, or your strategy and your tactics begin to change based on what is occurring and what has not occurred. Yeah, your probabilities begin to switch to the initiative situation, Robin. That's exactly right. Roberto, why do the probabilities begin to switch the initiative situation? Well, it begins to switch the initiative situation for the simple fact that there's a 95% chance the higher the low of the first 60 minutes of trading is going to be taken out during the day. And so each rotation that occurs in which the higher the low of the day is not taken out increases the probability of it being taken out on the next rotation. So if in the F period or G period or H period we haven't taken out the higher the low of the day, if we begin testing the extreme, yes, for instance, take a hypothetical. Yes, if we're testing the low of the day, that would, in a rote mechanical sense, be a great reward to risk long, okay, from a reward to risk perspective. But remember, the expectancy equation is not just reward to risk, it also involves the probability of the trade working. And so if the market has not taken out the higher the low of the day, the deeper the day goes into time, the higher the probability that low or high will be taken out when it's tested. So the probability of the market holding in here begins to decrease as time passes during the day. Skip, why does that happen? It's just it's a statistical fact. And let's look inside the statistics. Why would there be that statistical tendency? Well, the purpose of the market is to facilitate trade, and it typically does that in a range, and that range is generally greater than the range established in the first 60 minutes of trading in the stock index futures. Roberto, you say, is this true for all markets other than the indices? The short anecdotal answer is yes. I haven't studied it, but I think Robin and Harris both may have looked at the tendencies of oil and gold to trade outside of a certain time period range. So it does exist, and a lot of it has to do with when when certain markets in certain sessions open. I would say yes, but the full disclosure is I haven't done any work on it. Robin confirms that they do. Yeah, and Robin, this is a good general point. You should understand the character of all individual contracts, trading instruments. Roberto, you say you are still nervous that this can go against me. What do you mean? Take the low of the day out? Yeah, that's what we're talking about. It's increasingly likely that as the market approaches this low, it's going to take it out. Or if it approaches a high, it's going to take it out. Okay, Giampolo alerts us to the fact that we've been going now for another hour, so let's take a 5-minute break, guys. All right, so we were talking about, to bring us up to date here. Okay, Daniel, you asked a question. So we're assuming that this trade will take out the low, and if you're still in the 14th trade, do you move your stop? No, because you're in the trade. You say the 14th. This is 11.4 actually. Uh, if you added to your position on 11.4 based on a macro assumption of what's gone on over here and the information from this day, you don't move your stop. Your stop, if you entered down in here, still has to be, I don't know, 12, 14 or so. So you're a couple handles down here. You may be risking 4 or 5 handles and along from over here, but that's a swing trade, and your potential is who knows what. It's certainly a multiple of 4 or 5 handles. So your reward to risk has to be predicated on the type of trade you're taking. Is it an intraday trade? Is it a swing trade, etc.? Now, there are times when you will adjust your stop on an intermediate term trade based on what the shorter term structure and development is doing. But this is not one of those times. Nothing has changed. If I'm long from 11.2 or I've added the position at 11.4, there's no reason based on anything that's happened during this day that would cause me to change to raise my stop or lower my stop, or raise it, not lower it, raise it. Okay, so anyway, we have determined that there's a 95% chance the market's going to trade above its high or low, and that you're increasingly want to be cautious about fading the extremes until the high or low is taken out. So here you go. We eventually had some extension outside the initial balance period to the upside, and it was an extremely choppy rotational day. Now, implicit in this, I can't overemphasize enough why it's so important to know when and where to trade, and to only trade at those times. And if you do that, you will avoid this. I have a friend that says, one of his sayings, you guys have heard me say this, this is the type of day where even the liars lose money. And the reason, the genesis of that statement is that the market is choppy and whippy most of the time. Most of what occurs in the market is noise. You have to make money trading in any time frame, whether it's swing trading or intraday, you have to define your trading to the greatest degree possible to avoid the noise. And the noise is most easily avoided at the extremes. So my long worked really well, and so did Robbins. Trevor added to his position again. He's now long 200 ES contracts. Now, what has today done? Now you've got great evidence that you're building a balance area, right? Yeah, this is just another piece of the puzzle. Now, coming into the 8th, nothing has changed about our macro assumption. Everybody agree with that? But now we have sort of a subset assumption working, and that subset assumption working is that we're forming a balance area. So if we put the subset assumption, which is that we're forming a balance area, and we extend it back to our larger assumption, what are we beginning, what are the implications going forward for this developing balance area? Now we're not looking from the past, Roberto. We're looking now for the future. You say it was a tough trade to get into. Well, actually, you know, you had a wonderful opportunity here to get into a trade. This was more aggressive, but actually you had, you know, this D period would have given you an opportunity for a relatively graceful entry with a very defined amount of risk. Okay, so what are we looking for eventually? If we're in balance, what happens next? Imbalance. Is there any sort of idea? Do we have any rational reason for thinking that balance area could be up or down? Why? Why up? Bigger picture, yes. Roberto, it's not that it hasn't been touched, it's that it hasn't been taken out. I realize that's semantics, but it's important. It actually has been touched. I mean, this was the upper cusp of that, but yeah. Okay, so now, if we're coming into the ninth, what are we looking for? What are our key reference areas? All right, Daniel, you say, sorry, but you just said something that confused me. You said D area would have a defined amount of risk, but you previously also said you wouldn't take it because it was a minor POC and not an extreme. Am I understanding that concept of area correctly? No. Yes and no. Let me go back. Okay, this is where we started. Now, when I was positing the question, would you go long here? Robin said he would go long here. I said I wouldn't. And I said I wouldn't, even though I do realize it traded into the high volume node, and that if this is 1030, this could be an initial balance period trade. I said I would be more comfortable if we traded down to here, based on the information we have at this point in time. Okay, and then we had another rotation. And at this point in time, I said, okay, now we have a market that is traded for a longer period of time without taking this low out, and I would be inclined at this point to take that trade. Now let me explain, Daniel, what the decision-making process. Trading this way is like playing poker or bridge or chess or these other games. Games like that. And all of those also are similar in that they involve probability. And if I'm playing poker or I'm playing bridge, or let's just take poker, everybody knows how to play poker. If I'm playing poker, each card that is exposed has an effect on my hand. And it could increase the probability of that hand working, or it could decrease the probability of that hand working. But I have to make decisions based on that card. And then the next card is exposed. And that could completely change my strategy and my tactics and the probability of how I'm going to bet. And that's what this does. This additional information on this day changes the probabilities that this is the low of the day. It increases the probabilities that this is the low of the day. Okay, so back to this. All right, now things are beginning to get exciting if you really understand what we're doing. We have completed the third day of a potential balance area, right? Now, is this a mature balance area? Giampolo, you say no. Why not? Well, can a balance area be mature in 3 days? Yeah. The answer is here, you don't really know. But what you do know is that it is becoming increasingly mature. So we have to be increasingly alert to the initiative move, right? I mean, that's the only takeaway. That's the only logical takeaway you can have. I can't tell you how many days it takes for a balance area to mature. It usually is more than 3, but there are times where you get a 2-day balance area that's acts just like a 5-day balance area. But you trade them basically the same way. You know now what the parameters of this balance area are, and that's enough information to trade with an edge. You know what the high is, you know what the low is, at least based on the information you have at this point in time. So you know where the trade location is, and the trade location from this is enough to, if you get to that point, you can enter and have an edge. Okay, you say, Tom, on day 3, would you short the high? Well, this is the 3rd day. You mean on the 4th day would I short the high? Let me put it this way. If you short the high coming into the next day, it's an aggressive trade. And shorting the high as each day continues is increasingly aggressive and increasingly has less and less of an edge under your macro assumption. The macro assumption is that this thing is going to break to the upside. So based on my macro assumption, based on what happened over here, the highest probability trade and the highest expectancy trade is to look for longs, and hope that I've caught a long in a situation that's going to become initiative outside of this balance area. Okay? I don't understand, Giampolo. You say, if we are long on day 3, would you hold the trade? Yeah. If I'm swing trading and I'm long, there's nothing in here that invalidates that. As a matter of fact, I'm looking for the opportunity to add to that trade. Okay. Now, this is where the market closed. We come into the 8th, and the market gaps down. Now, let's take a hypothetical. Let's say it closes right here at 10 o'clock. We're about to begin the next rotation. Is there a trade there? All right, Skip, why? Why are you going to buy it? Unfair low? Why do you say this is an unfair low? Almost? No, it's really not even almost an unfair low. All right, if you go long here, where's your stop? Below unfair low. Okay, so is this what you're calling the unfair low? Okay. Yes, that's if you go long anywhere in here, at this point in time, your stop has to be below this level. Okay, now, all right, the second rotation completes and the market is about to begin the third rotation, and it's trading right where my arrow is. What do we know? We've got a really narrow range, and we know that this range is going to extend, right? That's one thing we know. Okay, so the day completes. Now, what additional information do we have? Coming into the ninth, it's becoming mature. That would be a safe assumption, Giampolo. And look where this market closed. I mean, this is a poster child for balance. Now we're getting increasingly excited as traders because this thing is getting more and more mature. And we have an assumption, a longer-term assumption, that if it's correct and we're able to get a long trade on, we should have a really nice trade. Now, as this thing matures, how likely are we going to want to be to sell up here? It's decreasingly a trade with a good expectancy. All right, if we're not in a position and the market trades up here, are we going to go long up here? Yeah, you could. Absolutely. You should be willing to do that. Okay, this is where the market closed. This is where it opened. The first rotation is complete. Let's say we're trading right here. What do you do? You go along with the stop below yesterday's low. So, Elena, you're going to buy it here and you're going to stop it out below here? Okay, and re-enter again if it trades lower. Okay, that's acceptable. I can live with that. Okay, we've got another rotation that's complete. Now, T-Bone, you bring up an interesting point here. By mature, The balance is mature. You're looking for the initiative move from the high volume node. So you're not going to add to your 200 contracts yet, right? This is a more advanced concept. Now, what Trevor is saying, you've got, if we were to collapse this, which we'll do in a minute, you would have a high volume node right in this area in here, near the midpoint of the range. So he's saying at this point, he's going to try and catch the break, the initiative break. Because if this market is going to break initiatively, it's going to have to trade above the high volume node. So he's going to use that as confirmation or as a signal that the initiative break may be beginning, and then he's going to add to his contracts. Okay, so Trevor, are you buying this now? Are you adding to, I should say, are you adding to your position? Because you bought the low of the second and you've added all along, so you could be about to exceed position limits. Okay. You think you're still sitting, what are the internals like? Okay. Well, we're not trading the internals right now. You're starting to waffle on me, Trevor. Okay, so basically what we have a market that is rejecting the low, it's trading higher, but we're still in the balance area. But we are increasingly alert for an initiative break to the upside. Now look, we've traded into the selling tail from the previous day. Does anybody want to sell this? You're not going to sell it, Elena? Okay. Whoa. Okay, huh? Now, Trevor, are you adding to your position? Not yet. You're going to let a balance form. A balance in what time frame? Okay, now, what does this look like it is? Yeah, it looks like it's big money. It looks like it's the initiative break, right? It looks like we've transitioned now into the next phase of vertical development outside of a mature balance area, doesn't it? So this is either an initiative break or it's not, right? Now, if I'm long, or I bought up here, or even if I bought down here, and for a day trade, what would invalidate or what would bring into question my assumption that this is the initiative day that I've been looking for? Retracement. How much retracement? All right, Trevor, trading back below the G's. Well, based on just this information, Trevor, that's the right answer. That's all the information you have. Trading back below the G's would be the disaster stop for a long position. Based on again, it's like playing poker, bridge, or chess, or whatever. We're waiting for the market's next move, but based on the information we have, the cards on the table at this point in time, what invalidates the trade is if the market trades below here. Now, the reality of this is, okay, this is conviction. This is big money. So if the market retraces into it's acceptable for the market to retrace somewhat into this range. Some of this is very likely to be short covering and stop running, because you had all these stops clustered up here, all the faders trying to fade this market. So they came up here and ran the stops. So it's normal to get some sort of reaction off of this. Now, if this is big money, this area, this entire area should not be completely retraced. But at this point in time, we don't know how much of it should be retraced. So to Trevor's point, based on the information at this point in time, we're stuck with the idea that it has to trade all the way back down to here before it invalidates a long intraday trade. Okay, now, this is typical, and this happens a lot. What this turned out to be was an extension of the upper extreme. Now, the market traded up into and through the highs. The market had a second rotation that made a higher high. It had a third rotation that was an inside range inside the H period. Now, Trevor, this speaks to what you're talking about here. At this point, you really don't want to see this market trade much below this level. So if I were trading this for an intraday trade, I would probably have my stop somewhere in here on intraday longs. There would be no reason, based on this rotation followed by this rotation, to let it go all the way back. And it didn't go all the way back down to G. But I'm not going to let it go very deeply into this range, personally. Okay, now this day is complete. Now what do we know? Has this invalidated our bigger assumption? Has this invalidated our secondary assumption about what's going on? What information has this day given us? Okay, let's see. This is a good long setup from the big high volume node. We're trading around the new high volume node being formed. We tested new highs, and the G's that got us there held. That's a good point. We are on the top half. Giampolo, it could go the other way around. This could be a false breakout, right? We're trading on the long side of the slope. Could be rejection from unfair highs. We should consider that, and also as a potential add. Everything you guys just said, and Mel, range extension, everything you guys just said is true. But now I want to get back to the question that has to be answered. We came into this day under the assumption from a long-term time frame, that the trend of this market was up. And our assumption, and we stipulate that our assumption would be invalidated if this high volume node is taken out. So did what happened today affect that working assumption? No, it did not. Giampolo, you say yes? Why do you say yes? Did the market trade below this level? That's the only thing that would invalidate my working assumption. Okay. Now, my secondary assumption is that the market was forming a balance area Has that been invalidated, that the market's forming a balance area? No. More likely than not, and this is a logical extension of my bigger assumption, more likely than not, is that all we've done is extend the range by 2.5 handles. Now, if that's the case, has anything been done to my assumption that, or should I change my assumption about the transition from this and the eventual vertical break being to the upside? Somebody else want to weigh in? Giampolo says no. Does anybody think it does? No, it doesn't. This is just additional noise in a balance area that's extended the range. But my bigger assumption is still intact, and my secondary assumption is still intact. But now, what has happened? What has happened? We've got another day of rotation, right? Now we've got 1, 2, 3, 4, 5. So coming into this next day, the odds have significantly increased that we're closer to that initiative break, right? Okay. All right, we come into the 10th. The market opens here. It trades up to here now. It closes at, you're getting ready for the second rotation to begin. Is there a trade to be had here? Does anybody want to take a trade long or short? And I'll tell you, you're sitting right on the high volume node with the market right here. So nobody's going to take a trade. All right, you're going long, Emil? Okay. Where's your stop? Elena, you're going to go long with a stop not too far below this low? Below what HVN? Below here? Composite. Well, the composite HVN would put you, if you're going to use that, and that's a good point, that's still going to be just a few ticks below the low of this rotation. Okay, so Emil and Elena are long. Okay. Okay. Skip, you're going long at their stop. All right, now we're just about to complete. It's 10:30. The market's trading here. What do you do? You take whatever constitutes your maximum amount of risk and you go long. This is about as close to a slam dunk trade that you get. Not that it is necessarily going to be right, but because it's so defined in terms of structure in the bigger picture. You've got an increasingly mature balance area. Your working assumption, longer-term assumption that the market is in vertical development up is still intact. And you're within 3 handles now of make or break. for your working assumption. But if your working assumption is correct, you've got the greatest risk-reward trade you're ever going to get. Robin, are you going along here? Trevor, you've added another 500 contracts. Just 300? Okay. Congratulations. Now, I realize this was yet another well-chosen example. But the guys that are taking this seminar, that have taken it in the past, or taking it the first time, that have been in the room a while, know this happens over and over and over again. This is not some pie-in-the-sky event that occurs, once every leap year. And this is what you're trading for. So review this example. Go over it and over and over it. Everything that you heard here, the decisions and the questions that I asked you could have been answered from the material presented yesterday. And everything that you heard yesterday through this, if you learn it and you study it, can have an immediate and dramatic, well, I won't say immediate because it's going to take you some time to really absorb it, but it can have a dramatic impact on your trading. It really, really is. This is how we trade. Everything that you see is very consistent with how we trade every day. And regardless of the contract, this happened to be the S&P Mini, but we're looking at oil the same way, gold the same way, the stock, the currencies the same way, you name it. Raphael, you're right. Tom, in reality, he says, in reality, you could have taken a long or short trade in that location. It was either a responsive or an initiative trade. The problem is to identify it before it happens. Okay, to your point, Raphael, you're absolutely correct. All right? But this is what changes the probabilities of going long here versus going short. Because you're going to get a sharp move away from this area. And if this market takes this level out, it could be a very sharp day down. But the reason for going long here is because of the long-standing working assumptions about what happened over here. That's what tips the balance in favor of leaning to the long side. But in terms of going short here, yeah, you could have gone short here. But based on the information we had and logically following it through, the thing to do was pretty clearly to go long in here, based on the information it had and our working assumption that the market had broken out of a larger degree intermediate long-term phase of balance. And so this is what all of these days collapsed looked like coming into the 10th. Now remember when I used the example of sticking up the finger on my right hand and extending my fingers on my left hand and putting my right hand next to my left hand and trading the context of the left hand. That's what this is. This is the finger and this is the 5 fingers in the hand. This is the development that you're trading here. And here's another point. Let's say you didn't get this entry down here because you saw this cratering and you said, nah, I'm nervous. I think it's going lower. I'm not going to do it. I'm not going to buy it. Well, you had another opportunity when the market traded over in here. and tested this area in here. If you'd gone long here and used a 3.5 handle stop, you still had an incredible reward to risk trade. But you knew, you still had your bigger assumption to lean against here to help you make a trade decision and to have a rational, logical, consistent, objective basis for making a decision. Robin. Okay, this is a good point. You say, but at times you say, Tom, to be on the price side of the bigger high volume node with what is now a mature balance area of 5 days. Yes. Now, but when I say that, remember, I always preface it with in a vacuum, based on the information at hand. As a general rule, when you're trading near the high volume, when you have a high volume node and you're trading near the high volume node, just based on that information, the only edge you have is favoring sides on the price side of the high volume node. That is a different situation than this. If you're down here, if you're trading down here, you're in a key reference area. If you're trading in here, you're at a different key reference area. You've got different, and remember this too, Robin, but this is a good point. I say, if you're trading near the high volume node, the only edge you have is to take trades favoring the price side, which means if you're down in here and you're near it, you'd be favoring shorts. But I also turn around and always say it's a different trade when you're down here. Okay? This is an extreme. And even if you'd gone short here, Robin, for some reason, you've got trade management decisions to make down here if you went short, because you're at the extreme of a mature balance area. Forget the fact that you've got a longer-term working assumption that the market is developing up. Emil, this would have been a scary thing to watch. The only way you could have gone long here is to have this bigger assumption going for you and knowing where to trade. But you also, this is about reward to risk. We have trades, and Robin will tell you this, we take trades all the time where the market's going to move very sharply. And the test of whether or not that is a good trade is not whether or not it makes money. It's what happens when the market begins to move away from that area. And if I take a trade here, let's say I go short, that's not necessarily a bad trade. Forget the fact that I've laid out a case for it being long. But it's actually a good trade because it moves so sharply against me. Now, I'm not going to take a long down here and stop it out up here. I would never do that. But this is a situation, and I'm pretty candid about what I do and why and when. I'm pretty consistent. I would have been buying this with both hands. Okay? So guys, we're at a good stopping point. So let's take about 45 minutes for lunch. And we'll come back. So hold these questions, and we'll start with this after lunch, guys. So let's reconvene at 12:45.